back again. Episode 4. We've made it. 4 episodes. Well, 3 at this point, but we're going to do 4 today. And we are excited once again. We've got a handful of things to cover today. Consumer confidence and the stock market. I had a sneaking suspicion that there was a correlation or an inverse correlation to that, and Hao's got some data on that for us. Retesting the market lows. The market's recovered a lot since the June 16th low. And so what are the odds that we actually go back down and retest that low? We're going to talk about that. We've got some interesting housing data, albeit confusing. So at least we've got some interesting data to cover there. And we'll see where it goes from there.
All right.
So how's it going? Yeah, go ahead. How's it going today?
Yeah, it's been feels like it's been a while since we talked, so it's always great to see you.
Yeah, absolutely. You as well. Well, I know last time you were in a really good mood because the market was going the right direction. So how's your mood today?
It's up and down. So yeah, I did stick out my neck out on a limb and say that the market bottom was June 16th, and we're getting some choppiness. This is recording on August 25th, so this is the day before Jerome Powell makes his big speech tomorrow. So what we're looking for is he's going to come out and really be, I guess, hawkish, if that makes sense, that term. Be really aggressive in, we're going to fight inflation, we're going to slay inflation, we're not going to make the mistake of the 1970s where as soon as the economy showed a little bit of weakness, we took our foot off the brakes. And the mistake of the 1970s was the Fed was not aggressive enough to finally slay inflation earlier in the decade, right? And we're seeing ripples of that kind of strategy coming up again. And really the biggest battle is inflation. How do we finally slay it? Do we need a recession to do it? Is soft landing possible? And ahead of that, trying to find the right words, ahead of that speech tomorrow, how aggressive is Powell going to be? And I think that's really going to shake or confirm the markets.
It's interesting because I think if we had chatted maybe even a month ago, it was like, there's no way we're soft landing this thing. Like, we're going into recession. I shared that story of being in the bus or the shuttle coming back from the hotel, and this young kid was like, we're about to go into a recession, and 70% of consumers thought that. And I guess we hit it from a technical standpoint, but we aren't officially there, maybe by some definitions. But what's interesting is it might actually be appearing that we can soft land this economy.
Yeah, we're seeing the things that we've mentioned from episode 1, where we think it's a supply issue, right?
Mm-hmm.
Inflation can naturally go away as long as we can keep up our improving supply chain. And anything that rocks it, like war in Ukraine anything that rocks it that we don't expect can definitely happen. But that's what we've been seeing since May.
So has there been any good news since June 16th?
No. I read CNN, so there's been zero good news. And in real life, the only good news is the market's gone up, right? And even though it's been a choppy week, we're still recovered quite a bit of the lows, right? We peaked at negative, or bottomed at negative 24%. Mm-hmm. And now we're looking at negative 13% year to date for the S&P. And that's actually really, really great news. If you didn't read any headlines, you would have thought things are going really pretty okay. But no headline has suggested, go ahead and start investing now. And that's what I'm saying is, you don't need CNN or Fox or MSNBC to say things are rosy, go ahead and invest.
Now's the time. Yeah.
Yeah.
And that's common, right?
Buffett
I mean,
says, buy when there's blood in the streets. There's been blood in the streets for 6 months. Like let's buy.
Yeah, it's so interesting, right? We all want to do the opposite of what the media is saying. And I think the media, gas prices have been going down, which is great. Well, no one's talking about it. Gas price increases got 20 mentions in, I believe, the New York Times. Gas price decreases got 1 mention in the New York Times. So it's, we're setting this up against ourselves for negative news sells. So when the market does actually do good things, no one really knows about it.
Yeah, well, gas prices going down. I'm seeing a lot less gas pictures on my social media feed. So I don't know if it's like a media thing or just generally people focusing on the negatives. When prices were high, I could generate a lot of likes, right? Here in California, $7 a gallon gas just posted on my feed. All of a sudden I get people's attention. It's still $5 here, significantly improved, but it's still very high. That's not going to generate as much attention, right, as it did in June. Yeah.
Okay, so let's talk a little bit about consumer confidence in the stock market, because this is related to this. It seems like the market's bottom June 16th. It's kind of gone up since there. It's gone up about 50, it's retraced by 50%. So we have some interesting data on that. But after our last call, I had asked you, hey, consumer confidence, I'm seeing all this stuff in the media that it's never been worse. More people think it's the worst time to buy a house than ever before, and more people have negative sentiment on the economy. But what do then forward market returns tend to look like? And you've got an interesting chart here from JP Morgan.
Yeah, our partners at JP Morgan, they put out a consumer sentiment line chart. Essentially, is instead of tracking the stock market, they track what consumers feel about their finances, their job security, their just general outlook as it relates to money, right? Sentiment.
And I think that's just a phone call, right? It's a random poll.
I think it's done by the University of Michigan.
Mm-hmm.
They've been doing it since 60s or 70s. So it is polling, but if you get enough people to answer your polling question, you can definitely build some data off that.
Yeah, I've heard that it's just as basic as they call random people and they say, how do you feel about the economy? Good or bad? And then, how do you feel about this other thing? Good or bad? And that's how they gauge their survey, which is surprisingly accurate. Just get how the people are feeling in general and post it.
Yeah, and people are feeling pretty crummy. And we've talked really briefly about this, where June hit the bottom in the history of this measurement, right? We hit a flat 50, and this is on a scale of, believe it or not 100, but 120. So 50 out of 120 is like more than failing, and things were pretty bad. And 50, for context, is lower than the Great Recession, right? We bottomed around 55 in the Great Recession from its worst. 1980, we had a 52. So we beat 1980. 1980, for context, we were coming off high inflation from the 70s.
You're telling me that people feel worse today than they did in 2008?
Wild, right?
Why is that? How is that?
I think a lot of it has to do with inflation stings more than losing your home, which is really odd. 2008, 2009 were pretty scary times because not only did people lose their homes, but there were high jobless rates, and these were good paying jobs that were lost. And to feel worse about it now, this situation versus 2009, doesn't really square with me. And again, I'm gainfully employed, so I'm going to have bias there. But just looking at the data, there's probably non-economic reasons for this.
It's actually, I'm looking at this chart a little bit closer now. May of 1980, sentiment bottomed around 50, a little bit above 50. Still worse today, worse than ever before. August of 2022, it's a little bit higher now, but a couple of months ago it was worse. So you're right. Last time, everybody's experiencing really high inflation. You get the call, hey, I don't feel good. This doesn't feel good to me.
Yeah. Yeah. Everything's more expensive, and I take it personally because it feels like someone is taking money out of my wallet.
I was
But
just talking about, we were talking earlier, going to the grocery store. Grocery experienced 13.1% inflation last month in July. The month before, it was like 1% and change. I'm totally seeing that. I don't know if anybody else out there is feeling that. It seems like everything I buy at the store is $1 more now, right? And
you're probably getting less of it too. So
maybe
there's
so.
a shrinking factor. So you're getting less metric weight from it.
Yeah.
And you're actually paying significantly more for a lot less.
Okay, so let's come back here to sentiment. So then so when consumer sentiment bottoms, what generally does the market do after? Like, is it a signal to invest?
Yeah, you started at the top with the inverse relationship. What we mean by that is when things are feeling bad, when consumers are feeling bad about their outlook, that's probably the best time to invest. So the JP Morgan measured the last 8 sentiment troughs, meaning when sentiment bottomed, what did the next 12 months look like in terms of return? On average, that was 25% up for the next 12 months. That's a really healthy return. Good. And now let's flip it though. When things are feeling really good, right? When sentiment's peaked, in 2000, January 2000, sentiment peaked at 112. What happened the next few months in January 2000, right? February 2020, sentiment peaked. January 2007, sentiment peaked. Like, we're probably the worst predictors of the outlook in life because we tend to, like retailers, right? We overorder when things are looking good, only get slapped in the face with reality. So when sentiment peaks, the average return is significantly lower at 4.1% over the next 12 months.
It is worth noting
because
sorry, go ahead.
Yeah. Oh no, it's because we were a little too optimistic, right? And the opposite's happening is we're a little too pessimistic about our outlook.
Yeah, it is worth noting that it is changing. Positive. Like what I was hoping you would tell us here today is, when sentiment peaks, and I don't know how to gauge a peak, but you could just look at historical data and say, it's near prior highs. Maybe I should sell, or maybe I should kind of risk off. And when it's a low, maybe below 60 or below 65 by this, chart, maybe then it's a buying signal. It's not really that clear. In fact, there was just one time here in March of 84 where sentiment peaked, but actually the forward 12-month return was plus 13.5%. That's good. You would have missed that. So I guess nothing is perfect, but when confidence is low, generally the next 12 months of returns are quite a bit higher than when confidence is high. But in all instances, on average, it's positive.
Well, let's zoom out from confidence and look at the markets, right? So we can overlay the confidence chart, and it could probably mirror the S&P or the stock market. So people feel bad when the stock markets are going down. People feel good when the markets are going up. Mm-hmm. But when you're feeling bad, that's buy low right there. And when I started the show, I was saying that, but it's not as easy to do in real life than to say, right? Oh, I'm in 2007. I'm just going to buy low and sell high all the time.
Yeah, and it's hard to gauge where the low is, right? Like, okay, such an obvious signal. Never been lower. Okay, well, might as well buy some. But what if it just keeps going down? And I think that's the challenge that all bears have, right? It's like, well, it'll keep getting worse. It'll keep getting worse. It'll keep getting worse. And as we said earlier, there's been, to my knowledge, no good news. If anybody's seen any good news since June 16th, please send it over. I don't think there's been any.
Gas prices, that's the best news.
It's not even in the news. Yeah, gas prices.
Yeah.
Good point. There's a lot of good things happening. They're just not in the news. How about that? So the other point here that's related, and I saw this post here recently. This is from Ryan Dietrich, and it covers when we hit bear market. So a technical definition of a bear market is a 20% fall from a prior high. So when we hit a bear market or a 20% pullback from a prior high, once we've gone back up 50% of that. So go down 20, we go back up 10 of that, roughly. Has the market ever retested the prior low of being down 20? And that answer is no. So let me back up and say that again because it's a little wonky. So market goes down 20% or more, which is the technical definition of a bear market. once it recovers half of its losses from whatever fall it was, it has actually never gone back down to go lower than that original low. And further,
over the next year, though.
correct.
Right?
Yep.
Yep.
And further, over the next 1, 3, 6, 12 months, markets are generally really positive. You might be sensing a theme here. 6-month forward returns on average, this is dating all the way back to 1956, believe it or not, just shy of 11%. 12-month returns just shy of 20%. So, this is just interesting connection to what are maybe buy signals or what are signals to not be as fearful of outright loss. As our listeners know, diversification is our key to getting from point A to point B. We can bring a lot of confidence with that because you own a small sliver of a little bit of everything. But even further, knowing that things do recover eventually, it's promising. We'll get through this.
Why do you think that is, though, that things recover eventually? I have an idea in my head, but I just wanted to know what your,
you asked me this last time, and I don't know if my answer was great, and I'm still stumbling over my words for the same answer. It's just things kind of get cheap. It seems like, if I'm going to buy a thing and that thing is getting more expensive, and then all of a sudden that thing drops significantly on a major sale, I might actually go and buy it. And I think it's kind of the same thing with stocks, right? Like they keep getting more expensive. I can't buy it now. I can't buy it now. And then it drops. It's like, well, I don't know about this, but it's lower than it was, therefore I buy. I think it's just kind of things look to be on sale. And at some point, investors do in fact buy.
Yeah, and I think to build off that, I think it's appropriate to look at why things are on sale, right? There were just simply more sellers than buyers the first 6 months. And what those people or those investors did, right? They either held cash or bought something else. And that's a lot of cash to sit on the sidelines. Most likely it was just those sellers who sold, more power to you if you sold to the bottom. But if you sold and sat on cash, you're probably looking for a re-entry point, right? The money has to go somewhere, especially if you're an institutional investor. You can't just sit on 50% cash and expect to keep your job in this business, right? You gotta deploy that cash. So if you're on the sidelines, you're getting off the sidelines, one, for performance reasons, for fear of missing out, for a variety of reasons. And a lot of mechanics behind it don't really rely on headlines. It should be the other way around, right? The headlines are cueing off what the market movements are, and they're just, CNN's just slapping a story to it. And people, traders, investors are going to trade on their own timeline, their own skill sets, their own needs, yada, yada, yada. There's millions of traders every single day. And that's going to have an impact on the day-to-day movements and the long-term movements, right?
You're talking mostly institutional investors, like hedge funds and that kind of thing? Or who you're saying 50% in cash. Are you talking about retail? Like who specifically?
Yeah. Bloomberg did another survey of professional investors, and this is the first time in, I think, 20 years where those investors had more bonds than stocks. And this was heading into
mutual fund managers? What's
the mutual professional money managers? Wow. It was a Bank of America survey where reported by Bloomberg where these professionals were on the sidelines because their figures were showing negative outlook.
Interesting.
Right? So there's still a lot of money on the sidelines that should be redeployed. I'm not saying it's going to be now, but that's uninvested money that needs to get invested.
Which, based on what we talked about earlier, it often pays to just be in an index fund, which is fully invested all the time. You ride the down, you ride the up, versus if you're in, say, a hedge fund or something that's trying to be in cash part of the time, or hedge over here, make a very, very active call on the portfolio. Clearly, as we've seen, you just told me there's more cash than there was, months ago, and the market seems to have bottomed and gone back up. Therefore, it was missed. Got to just index.
Yeah, and And to be clear, I'm not saying they're dumb or don't know what they're doing. If we go back to 2020, and there was another survey done on about 235 economists in August of 2020, will there be another double dip recession? Right. That was a point blank question. And 80% of them said, yes, the stock market's going to roll over. We're going to have another 80%. Recession. And these are, the world's smartest economists. And they're not saying this on a hunch. They're not saying this from their gut, right? They're using data, what they're seeing, using historical reference points. And they were wrong, right? If you listen to that advice in August 2020, where was the buy point, right? Because I don't think we had any dips really all year until November. And even then, you lost a big run up from April all the way through the end of the year. And similar to the fund managers that we're experiencing now, where they're relatively risk off or lowered their risk exposure, they're basing it on, data. But the market has different movements because not only are institutional players trading in and out, but it's retail, it's pension funds, it's endowments. Everyone is involved, and they're going to have their own reasons to get in and out of the market. And they don't really care if some mutual fund manager is risk off because his data points, poor data, right? But we say buy low. If your data is saying things are looking bad, things are probably cheap because they're looking bad, and you should be buying low.
I feel like I would be the most boring economist because I would just continue to forecast like, it's going to go up a little bit, rather than try to make such a call because it's maybe that's the financial planner in me or just the believer in diversification or whatever it might be. Zoom out, it kind of goes up, right? Maybe if you forced me, maybe that's what it would be. If you forced me to say, what's your prediction over the next 3 months or 6 months, I would just plead the fifth. But, if I had enough time, I would always say, generally things go the right direction.
Yeah. And they don't need a story to go in the right direction, right? The simple answer is there's more buyers than sellers. And there's perpetually going to be more buyers than sellers, right? And everyone who gets a paycheck, most likely, majority of people who get a paycheck get a 401k. They're constant buyers.
Let's pivot over to housing. Consumer confidence in housing has never been lower. No, correction. Lowest level since 2011. So not never, but lowest level since 2011. Both prospective buyers and sellers.
Can I interrupt? If you bought a house in 2011, Chris, how happy would you be?
Right?
It could have been in the middle of nowhere, too.
Great point.
Right?
Yeah, no kidding. Just 17% of those surveyed, this is from CNBC, by the way, just 17% of those surveyed in July said now is a good time to buy a home, down from 20% in June. Okay, whatever. 20%, 70%, that's the same. Even more telling, the share of sellers who think it's a good time to list their homes dropped to 67%. So people are going, I don't really want to sell right now, and I don't really want to buy right now. Interesting. We also see this.
It's a standoff. It's a classic standoff.
Good point, right? It's the we need more inventory to actually bring prices into a normal range, but people don't want to sell.
Not at my expense.
But it's funny because I had heard that Google searches spiked for sell my home quickly or some iteration of that. How do I sell my house this weekend? So people are thinking about doing it.
Oh, because they're trying to cash out the top, right?
It's going down. Get me out. Was what trending search for Google maybe a week or two ago.
But there's probably good reason for that, right? We look at all kinds of data, and Redfin is pretty good actually for up to the minute data because they have all these home listings, and they're seeing the number of, I guess, lowered prices. And I don't know what the term is, but like if you list a house, you drop your house price because you're getting 0 bites, right? the biggest boom cities that experience the biggest price increases, they're now seeing the biggest markdowns or the volume of markdowns. The data doesn't really show how deep the markdown is. Like, let's say you list your house for $500,000 and you mark it down to $590 or $490. That's not much of a markdown, but it's counted as a markdown nonetheless, right? Because the listing agent needs to say the original price and then the new price, which is in a lot of cases lower. And looking at the data, it's like Boise. Last year, 29% of all listed homes marked down. Again, we don't know the severity of markdown, but this year, July 2022, 70% of homes listed in Boise, Idaho have been marked down.
Wow.
And I would venture to guess a bunch of them still aren't selling and probably aren't even getting a lot of visitors. And another, kind of a sad stat is 77% of people who bought homes in the last 2 years regretted buying that home. A lot of people paid over listing price and they bought a home sight unseen. So now they're dealing with big structural issues, home improvement issues, things they have to fix, right? And the home, right, that they've been such a competitive buyer for is now suddenly such a burden. And I think that's what's scary is such a large amount of relatively new home buyers are
maybe
regretting
bodes well for inventory in future years. If confidence can come back up, maybe people actually sell those homes. As we talked about last time, we're just simply not building enough houses. We have more demand than supply, and there's kind of this perpetual uptrend in prices because of that. I think it's interesting though. So this particular post here that we're looking at, Boise's top of the list, 70% of homes dropping price here in July of 2022. They're labeling these as pandemic boom towns. So essentially towns that really, really grew when people weren't tied to a city anymore. They were just tied to a desk and an internet connection. And Boise is the first one. Denver, Colorado, 58% of homes drop price. Salt Lake City, 56%. Tacoma, Washington, 55%. Tampa, Florida, 52%. Sacramento, 52%. Indianapolis, 51%. Phoenix, 50%. San Diego, 49%. Portland, 48%. I keep going. Even Seattle, 47%. Austin, 46%. So point is a lot of price reductions. My question is, though, are realtors just not pricing it right? Like, I think if you're going to list a house and let's say that house 2 months ago was worth $1 million and you're a realtor walking in and you're like, it's not worth $1 million anymore. But it's pretty hard to get the seller to convince themselves that it's not.
That's where I was going to go. Is we probably have actually a bunch of realtors banging their heads against the wall because their sellers aren't.
Yeah, and I think that if it's not normal to sell in a single weekend, right, or in a day. Like that's not normal. It's normal to actually be on market for a couple of weeks, and we're all just used to this list and sell. I mean, your house is almost as liquid as your stock. And so possibly it's just a cause for education or a courageous conversation among realtors and their clients that says like, hey, we need to price it here. Otherwise, we're likely going to have a price reduction. And I think that's a tough pill to swallow for the sellers.
Yeah. And I think a lot of them anchored towards their most recent price before all this downturn when rates gone up, right? Affordability is an issue. And if you're not willing to back off the price, look, hold on to it if you can. But again, that might be a conversation for another episode. But sellers are unwilling to put their house on the market because they don't want to take so much of in their head.
I feel like Redfin kind of and Zillow, because they have like the this estimate and the estimate of your home value. It kind of you do it yourself, right? Because you can see whatever these algorithms think your house is worth, so therefore that's what it's worth. But those algorithms use, I guess no one knows exactly what they use, but assuming they use closing sale data to come up with what they think your house is worth, that's a lag, right? That's at least a 30-day lag, because when you buy, it takes 30 days to actually close. And so that's probably where a lot of these overpriced homes are coming from, is people are looking at their Redfin estimate saying it's worth $1 million. The realtor's like, it's worth 850.
Yeah, keep it
and
with
then
the
they
Joneses,
settle
right?
at 925 or something, and
Yeah.
it still has to go down because it's sitting on market.
Yeah, well, you want to sell your house more than your neighbor did, so I
Right.
think it's a keep over the Joneses.
Lastly here, what are you seeing about rents? You got the slide here that rents are still climbing.
Yeah, rents are still climbing year over year, month over month.
Oh, good.
We're seeing a bit of a dip, but rents are amazingly high still. It's because of the affordability issue. When mortgage rates are pushing 5.5%, your house affordability has to come down, right? If you're in the range of $500,000 home previously at 2% mortgage rates, that's not realistic to pay that amount at 5.5%, right? And affordability has gone way down, so people need to live somewhere, and that's driving up rents, which is contributing to inflation. And it might have a reverse effect of what the Fed was intending with trying to get mortgage rates higher. I think it's just shifting one problem area to another problem area.
Well, it'll be interesting to continue to watch housing. There's more bad news there, which based on, I guess, our whole conversation today, might be an interesting time to buy in the face of bad news. But it's also hard when mortgage rates are, in the fives. So interesting headwinds. It's different. It's different when you're buying such a huge leveraged asset relative to, I'm going to invest the 401k money or the $1,000 that I had sitting on the sidelines or whatever it might be. It's just a totally different thing. Awesome.
Housing.
Well, that's all the time we have for today. So thanks so much, everybody, for joining. Thanks, Hal. This was fun as always.